So good afternoon, everyone, and a very warm welcome to today's webinar, which is a deep dive into the Metal Pulse report. So this is the SBI CAB Securities monthly Metal Pulse report for the March 2026, which myself and Shubham, my colleague, has made. So for the next hour or so, we'll be walking through this report page by page, and in the sequence we have prepared, starting from the report synopsis, which is page number 3, and all the way through to the global peers valuation table on page 27 and page 28. So the idea is that we have made this report so that you, all the investors and our viewers, are aware not only about the data points, but what does this report means to our investors in the terms of Indian metal stocks. So now quickly beginning and moving on to the third page, which is our report synopsis page. Yeah. So first, I'll be talking on steel. So the latest data, which has been reported by Joint Plan Committee (JPC), is the Jan 26 data. So talking about India's crude steel production for Jan 26, it stood at 14.3 million tons, which was up 4.1% YOY. And if you talk about cumulatively from April 25 to Jan 26, the crude steel production for India stood at 138.8 million tons, and this was higher by 10.6% YOY. And the reasons behind this were a robust domestic demand and a capacity expansion, which was driven by the large mills and higher utilization levels. Then moving on to our India's finished steel production. So for Jan 26, it stood at around 13.6 million tons, which was up 3.2% YOY. Yeah, so which was 3.2% up YOY. And talking cumulatively about April 25 to Jan 26, which is for 10 months. So our India's finished steel production stood at 132.3 million tons, which was up 9.7% YOY. Now moving on to India's finished steel consumption for Jan 26, it stood at 14.2 million tons, which rose 3% YOY. And talking about 10 months FY26, finished steel consumption stood at 133.7 million tons, which was up 6.6% YOY. So if you see the consumption growth for 10-month FY26 and the production growth of 10-month FY26, so the consumption growth clearly lagged behind the production growth. You know why? So the reason behind that was the monsoons had been extended and there was unseasonal rainfall, which hampered the construction and the infrastructure activities. So due to this, there was a clear gap between the consumption growth and production growth for 10-month FY26. Now moving on to the India's finished steel exports. So the exports rose 2.7 million tons in Jan 26 and registered a 10.6 month-on-month increase and a sharp 72.4% YOY surge. And if you look at the 10 months data, so the finished steel exports stood at 5.5 million tons, which was up 37.2% YOY. So the major reason behind this was that the Indian steel mills, they prioritize the export markets in FY26. This was due to the higher export realization as compared to domestic prices, and there was weak domestic demand, as I earlier discussed, due to the extended monsoons, which further encouraged the producers to redirect their volumes towards the export markets. And also, if you look at the EU buying, so EU buying in the pre CBAM phase, it supported the robust export momentum, and this offset the weakness in the domestic demand. Now, what do you mean by CBAM? So this is just out of topic, like not in a metals monthly, but if you look at CBAM, so CBAM refers to the Carbon Border Adjustment Mechanism. So this was a landmark environmental policy which was introduced by the European Union, which is EU. So you just think of this as a carbon tax on imports. So the goal was to ensure that the European companies who have to pay their carbon emissions aren't put at a disadvantage by the foreign competitors who might be producing goods in their countries with looser environmental rules. So now let us talk about the CBAM, that how does it work? So the mechanism, it is designed to equalize the price of carbon between domestic products and imports. So first, talking about targeting the carbon leakage. So this prevents the company from moving their production outside the EU so as to avoid the emission cost. Then the second, you have the CBAM certificate. So the EU importers, they have to buy the CBAM certificates corresponding to the carbon price that would have been paid if the goods had been produced under the EU rules. And if you are a non-EU producer, like if you're producing in India, so you can prove that you have already paid the carbon price in your home country, which is India. So that, and then you can take the deduction from the EU requirement. And this CBAM was in transition phase from 2023 to 2025, and now it has entered the definitive phase from 1st Jan 2026. Now, if you talk about, so from 2026, if you see, the Indian exporters, they must provide verified emissions data for every shipment. And if the emissions, they exceed the EU benchmarks, the EU importer must buy CBAM certificates. So, if you just talk about a rough calculation, like the Indian giant steel companies which are listed are Tata Steel, JSW Steel, Jindal Steel, and SAIL. So if you roughly calculate, so there is a tax burden of approximately 20 to 35% on the Indian steel exports, which translates approximately to $100 to $120 per ton of steel over the next few years. So this tax the Indian steel giants will have to pay. And so why is the Indian companies hit? So this is because of their production route, because most of the Indian steel companies, they use heavy blast furnaces. Like they are using heavy blast furnaces which are emitting around 2.1 tons of CO2 per 1 ton of steel. So, and the EU's baseline is closer to 1.3 tons. So the gap between 2.1 tons and 1.3 tons is the difference in which the tax has to be paid. So this was all about the CBAM. Now, if you move to the Indian steel imports, so the steel imports, fell to 0.3 million tons in Jan 26, which had massively declined by 73% YOY. And if you talk about the 10 months data, so the imports stood at 4.9 million tons, and this was down 41% due to the safeguard duty, which came in force from December 2025, and due to the higher import prices and improved domestic supply. Now, moving on to the India HRC prices. So if you look at the India's HRC prices, so HRC prices are nothing but the benchmark prices. One looks at the steel sector when they are going through the steel sector. So the India's HRC prices, they are continuously in the upward trajectory post the implementation of safeguard duty. And if you see, the prices were hovering at 47,100 per ton in December 25 on an average basis, and which has increased significantly to 51,989 in Jan 26. And talking about the current levels, which is if you talk about as of date, 18th March, so now they are prevailing at 56,500. So there has been a massive jump of 20 to 22% in the India's HRC prices. And this was basically due to the higher coking coal prices and restocking activities and improved market sentiment. So that is why this price hike has been sustained. And if you move to the 4Q FY26 results, so we anticipate that the third quarter's con calls were done, in which all the Indian majors, they listed that they are the fourth quarter FY26 HRC prices will be higher by approximately 2,000 to 2,300 rupees per ton if you compare it on a sequential basis. So this was due to the safeguard duty coming into place, and also the peak construction activity, which is the fourth quarter of any financial year. Side by side, if you see regarding the cost consideration, the coking coal prices have also increased, and the company will be reporting an extra $15 to $20 per ton additional coking coal prices in comparison to the last quarter. And talking about the iron ore prices, so the iron ore prices are more or less stable. So only the coking coal prices have jumped massively in comparison to the HRC price hike. So talking about the overall steel spread in 4Q FY26, so we will have a QOQ improvement, which will be a modest improvement, which will be supported by the recent increase in the domestic steel prices. And like the Middle East war, which is going on, has also added an extra layer of volatility in the steel markets, because that has created a demand supply constraints due to the conflict, and this has also helped the HRC prices to sustain. Now moving on to the iron ore. So if you look the benchmark iron ore prices, which is the 62% FeCFR China, it is averaged around $105 per ton in January 2026, which was up 3.1% month on month, as the Chinese mills had restocked that iron ore before their peak construction activity begins. And if you look at the international iron ore price, if you look at the domestic iron ore prices, so NMDC had taken a cut previously, and now they have increased their prices by 100 rupees per ton in Jan and Feb, and also in lumps by 150 rupees per ton. And currently they are prevailing at around 4,800 rupees per ton and 4,050 rupees per ton. Now talking about the aluminium data. So if we talk about aluminium, so the global production in Jan 26 stood at 6.32 millions, which was marginally higher, 0.3% month on month. And if we see the LME aluminum prices have been, robust, and in a year's time they have increased by approximately more than 50%. If you see, and they are currently prevailing at an average price of dollars 3,142 per ton in January, which was itself up by 9.2% if you compare it with the average price of December, and it stood at around $2,876 per ton. So the inventories were falling down, and you have a lot of demand supply gap in aluminium as well. So this has helped the aluminium prices to sustain at around more than $3,000 per ton. Talking about March, so currently the aluminium has hit an all-time high of more than $3,500 per ton on 6th March 2026. So this was due to the escalating US-Iran tensions, as the Strait of Hormuz, from where the exports takes place, that corridor, it supports nearly 9% of the global aluminium production, where Iran, Bahrain, Saudi Arabia and UAE, they are very heavily reliant on it for the trade. So due to this, the prices have shooted, and in parallel to this, Norway's Hydro, which is named as Quartalum, it's a JV in Qatar, where they have halted their production, and the company, it has a capacity of approximately 636,000 tons per year, and it has been shut down, and it is expected to conclude in March 2026. But if the if the company is shutting down its operations completely, then it will require minimum 6 to 12 months. So looking at this, the prices have been sustained. But if there is any de-escalation in the war, then you may see a massive nearby correction of 5 to 10% immediately in the aluminum prices, because the aluminum prices has approximately shooted by 10% currently due to this ongoing war. And if you see, in CY26, by the end of CY26, you will have another 2 to 3 million capacity coming on stream, and it will be approximately 77.2 million tons, where the incremental additions will come from Indonesia. And still the deficit will remain in CY26, and this relief will get mitigated in CY27 only. So now coming on to the copper. So if you talk about copper, so the copper prices have also been robust in January, where it has hit $13,000 per ton. And on 29 January, the copper prices, LME copper prices, hit an all-time record high of $14,000 per ton. So this was on the back of speculative buying in China, expectations of stronger US growth, and increased investment in data centers, robotics, power infra, etc. If you currently look at the LME prices of copper, they are hovering at around $13,000 per ton, and we expect these prices to remain on upward trajectory on back of the post-holiday demand coming from China. If you also look at the domestic Indian prices, they are also trending higher, as there has been demand supply gap in the scrap availability. Now, my colleague Shubham, he will further carry on and take you forward to our metals first report. Thank you.
So yeah, welcome everyone, and thank you so much for joining us. So the first few pages are rather a synopsis of the entire report and what we try to convey in the report. So starting up from where Harsh left, we see the second newsletter that is present. So this is nothing but the quick summary of the recent developments that have been seen in the domestic and the international metals and mining space. So this section is divided into two parts, which is domestic and global. So in both these parts, we try to cover majority any corporate related updates with regards to the operational performances of the companies, or any regulatory policies that have been released by the government or any other international agency. And we try to interpret the reaction of these policies on the sector. So now for this addition, I'll try and cut short this part. We can directly move towards the global part, and there are few major news that had happened over the past month. So if you look at the ferrochrome industry, therein South Africa has decided to cut the power tariff for its ferrochrome industry, which was previously at around 137 cents, which was then reduced to around 87 cents for an interim period of 12 months. However, the producers claimed that this was not feasible for them to sustain, and hence, after that, the power regulator in South Africa has decided to provide relief and cut that tariff rates to around 62 cents per kilowatt hour. So this is only done for two major players, which is Glencore Merafe, which is the JV between the two companies, and Samancor Chrome. These both are the leading ferrochrome producers in South Africa. Now, the implications of these are to be seen over the coming months with how the prices react and how these smelters become revamped again and how quickly they are able to revive their production. So this is something which is to be tracked. So the company which will be in focus with regards to this is Indian Metals and Ferroalloys in the Indian equity market. Next up, the major news was with regards to Indonesia. So Indonesia is the world's largest nickel producer, and the processing capacity utilization in the country has fallen to about 70 or 75% in 2026, which was prevailing at around 90% in 2025. This is due to the lower ore quotas that the country has provided to its miners. So the country's smelting capacity is around, it needs around 340 to 350 million wet metric tons of ore, but the approved quotas are only of 260 to 270 million. So these signals a huge deficit in the ore quotas, which are required to run their smelters. So these may be quite structurally bullish for nickel prices, and we will talk about this in detail further on. So this section, as I said, is a newsletter which covers the major developments that happen in the sector. And yeah, this will also be updated on a monthly basis, and then when we come out with a report every particular month. Now moving on, the next page, which is the commodity prices heat map. This I feel is one of the useful reference pages in the entire report. So it gives you the 14 months sort of price data across all the key commodities in a single table. So the investors can look at this table and see the price trends in all the commodities at a glance. On the ferrous side, if you look at the HRC prices, it has bottomed out at rupees 46,750 in November 2025 and has recovered to 53,750 by Feb 2026. Now, this is a 15% recovery in just 3 months. So, if you try and correlate this with the prices of the key ferrous players in India, you can look at Tata Steel, which has recovered quite well in terms of pricing. The stock has went from the price range of 160 in December and has now reached around 195, and it also had reached about the price of 200 a couple of months back. So you can clearly see the correlation in the commodity prices and the stock prices as well. Similarly, following on that trend, we have rebar prices, which have went from 47,000 in November to 58,650 in February, which is a 25% jump. Now, this reflects the strong construction demand recovery. Key talking point about here is that HRC and CRC prices are recovering quite well. But what is driving this recovery? Is it the demand-led recovery that we are seeing, or is it something other than that? So for that, we have to look at the coking coal prices, which are reflected in our report by the HCC prices. So when you look at that, it tells a worrying story. The prices have went from USD 193 in June or July 2025 and have all the way climbed up to $263 in February 2026. So this indicates that while the steel prices are rising, the costs are rising as well. So more or less, the hikes are led by cost pressures. It is important to note that these cost pressures have been prevailing for quite long back, and it was not fairly feasible for the steel mills to hike their prices up until the safeguard duty was implemented by the Indian government, which has now provided the mills to pass on their cost increases to the customers and thereby protect their margins. So the safeguard duty is one of the main reasons why the steel mills are able to hike their prices, and this will be discussed in much more detail when we compare the safeguard duty effect with respect to the China import prices as well. On the non-ferrous side, look at LME copper from 8,928 in January 2025. It has moved up to 13,294 in Feb 26, which is nearly a 50% move in 13 months. LME aluminium has moved from 2,592 to 3,128 over the same period, and it is now currently trading around its all-time high levels, which it had hit on 6th of March. And on the bottom side of the page, you can see the inventory section as well, which is showing that LME aluminum inventories are falling consistently from 5,88,000 tons in Jan 25 and are now at around 4,66,000 tons in Feb 26, which is around 21% decline month on month, year on year. So these falling inventories alongside with the rising prices are something which we consider to be a strong confirmation of a genuine physical tightness in the commodities. So this was a page which quite well covers the price trends and the inventory trends, so that the investors are aware about how the prices have been moving, and the same can be correlated with the individual stock prices as well. When we talk about aluminium, we can look at National Aluminium, which is NALCO. The stock prices have nearly doubled in 12 months. So these are certain correlations which are to be seen in the metals and mining space. Now moving on, when we look at the next page, it is more of a macro related page that shows the data pertaining to the ferrous global macros. So the page 8 gives the global production picture. The total world crude steel production was at around 147.3 million tons in January 2026, which came in down 6.5% year on year. This is largely due to China story. We will talk about this later in detail. So if you exclude China, the steel production is broadly stable or slightly positive. This YOY chart shows that the global production has been consistently negative year on year since mid 2025. And this is not a global recession sort of a story, it is a deliberate China policy story. The month on month charts show the 5.5% jump in January versus December, which can be implemented to be a partly seasonal effect, as December is typically weaker. The long-term trend, though, in the top chart shows that global production has seen range bound between 140 to 167 million tons per month, with structurally no structural growth. This tells you that the global steel market is not in a high growth phase, and the growth is happening right here in India, while China is actually pulling back the global demand and production scenarios. On page 9 and 10, we see the Indian data points, wherein investors who hold or are tracking the companies like JSW Steel, Tata Steel, SAIL, and Jindal Steel can pay close attention to, as these charts are what would directly drive the earnings of these companies. The production chart on page 9 shows that India production came in at 14.3 million tons in January. And you can see the long upward trend is intact, even though there is a slight month-on-month dip. The consumption chart mirrors this. The 14.2 million tons consumption in January is up 13.7% YOY. Steady growth is being witnessed in the Indian markets. But the most important one, I feel, is the import chart, which is to be looked at carefully. If you look at the final bar for January 2026, it is just around 0.25 million tons. That is the lowest monthly import figure in the entire chart history which has been shown. And the peak was seen back in February 2024. This is a visual representation of the safeguard duty being in full effect and almost immediately. For comparison, imports were 1.55 million tons in Feb 24, and they have collapsed by nearly 80 or 85% in 2 years. And this is meaning that the safeguard duty is protecting the Indian steel company revenues and market share. The export chart tells the other side of the story. Exports have been on a steady upward trend through FY26, from 0.4 million tons per month in mid FY25 up to 0.68 million tons in January 2026. India has found export markets in Europe and Southeast Asia, and this is not just a short-term opportunity. It is about India building its position as a credible global steel supplier. Obviously, after China has been curtailing its production due to the policy measures. On page 10, at the bottom of the chart of exports, we see the manufacturing PMI chart of India, and this is quite reassuring. Feb 2026 came in at 56.9, which is comfortably about the 50 mark, which is also known as the expansion threshold. India's manufacturing PMI has been above 55 consistently for quite some time now. This signals that factories, which are downstream steel consumers, are operating at healthy levels, which translate into good demand visibility for steel mills and the entire Indian steel sector. The government capex chart shows that there has been some month-on-month volatility. The January number was down 24.5% year-on-year, but on a cumulative April to January basis, the capex is at rupees 8,423 billion, which is up 11.2% year-on-year. The government capex, I feel, is the single biggest driver of steel demand in India, as these investments are reflected in the constructions of roads, railways, and housing. And the cumulative trend is positive, even if the individual months are lumpy. So, on a cumulative basis, this chart should be seen, which reflects that the steel demand is going to be translated into some serious project developments in the coming months or years. On page 11, we see the long-term price charts of the Indian sector, which are the benchmarks which we see to understand the sector at first. So page 11, the long-term price charts includes three main steel products, starting with HRC. The chart goes back to August 2020 and gives you the full picture. Prices have peaked at around 75,000 to 80,000 per ton in mid 2021. Thereafter, the prices have corrected sharply and have been in a range bound range, which is around 45,000 to 58,000 rupees per ton. The current average in February, which was seen at around 53,750, is recovering from the November low of 46,750. And however, this is still below the 2021 highs that we saw, but the prices are moving in the right direction, partly because of the implementation of the safeguard duty, protecting the industry from cheap exports that the China had been bringing into the Indian markets, and thereby restricting any price upsides. CRC, which is cold rolled coil, on the other hand, is at around 59,688 in Feb, up 3.2% from January. Rebar is the strongest mover, up 7.6% in 1 month to rupees 58,650 per ton. This strength in rebar prices signals that the construction activity is picking up sharply, which is very positive for the sector's near-term volume outlook. Now, as we have seen the prices of the main steel products, now let us move on to the prices of the raw materials, which are explained in the next pages. This page 12 shows the input cost picture. With NMDC lumps have went from a high of nearly 8,000 per ton in 2021 and now are trending all the way down towards 4,600 as of January 26, which is a 46% fall from the peak. They are now recovering to around rupees 4,800. For steel mills, the cheaper iron ore has been a partial offset to the rising coking coal cost. This was as I explained in the heat map page on page 4 or 5. Then we see the coking coal chart. As I said, it is a concerning one. The premium HCC prices have reached to 263 per ton in February, which is a 19th month high, and are up from around $189 in March 2025. The prices have then pulled slightly to $243, but are still 30% above from where it were a year ago. This is the primary reason why steel margin improvement in Q4 will be gradual rather than sharp, given the price increases in both the product and the costs. Now, let us look at the spread analysis. So, page 13 covers that portion for us. There are three spread charts that are critical to understand the profitability for steel mills. The HRC versus raw material spread is essentially the gross margin per ton for the integrated steel mills. So this spread has improved from the lows it had handled, but now remain below the highs of 2021. The safeguard duty-led HRC price increase is providing near-term relief, but the coking coal costs are eating into these margins for now. The HRC versus CRC spread has been compressing, meaning that as HRC prices rise faster than CRC prices, the rollers who buy HRC and convert it into CRC are seeing somewhat margin pressures. The HRC versus rebar spread has turned negative, meaning rebar is now more expensive than HRC. And a negative spread here signals that the strong construction demand, because rebar buyers are builders and infrastructure companies. They are bidding prices up aggressively given the strong construction demand that is been seen. Now, the next page for me is practically the most useful and the most important part of the report. It shows exactly what the Chinese steel costs once it arrives in India, and we sort of compare it to the domestic prices that are prevailing. So here is how it works. The Chinese HRC CFR price, that is the cost and freight to Indian port, is at around USD 505 per ton as of 10th of March 2026. Now, when we add the basics custom duty of 7.5% and the cess of 0.75%, you get the $547 per ton price one. Once converted into rupee terms at rupee 92 per dollar, the prices become 50,509 rupees per ton. Now the government has set a threshold price of $675 CIF. That means if the Chinese imports are priced below this, 12% safeguard duty plus a 1.2% sales applies. So the Chinese HRC at $505 is well below the $675 threshold. So the safeguard duty kicks in fully, which adds an additional $72 per ton charge. So after the safeguard duty, the cost is now at around $619 per ton, or in rupee terms, it is at around 57,176 rupees per ton. Adding miscellaneous and handling charges of around 2,000 rupees per ton, the landed cost of Chinese HRC is around 59,176 per ton. So now, when you look at the domestic prices, the prices are selling at around 55,500 rupees per ton. So the domestic steel in all is around 6.2% cheaper than imported Chinese steel even now. So this means that Indian mills have pricing headroom, and they can raise prices further before the Chinese imports become competitive again. And this is why we expect the HRC prices to remain firm in the near term. So this, as I said, is a really important page to refer to, showing the difference between the landed cost of the Chinese imports versus the domestic prices, and how safeguard the duty is protecting the domestic mills. So do check out this page every month, as this will let you know the future implications of the China dumping of exports. Now the next page is focus on the China macros and China steel production and prices. So when you look at page 15, China's crude steel production in January 26 fell 13.9% year on year to 75.3 million tons. You can see in the chart how the production has been on a clear downtrend since the highs of May 2024. This is the government's anti-involution policy at work, which means that China is deliberately curtailing production to improve the industry profitability and reduce the waste. But here is the paradox that every Indian steel investor needs to understand. Despite falling domestic production, China's steel exports have hit a record 119 million tons for the full year 2025. China exports more steel than India produces. These exports go everywhere, from Southeast Asia, the Middle East, Africa, and also India. So that is why the safeguard duty was India's direct response to these cheap exports of Chinese steel that China was doing. And when you look at the chart below it, the China's HRC inventory has jumped 31% in Feb 2026. High inventory in China means that domestic demand is not absorbing supply, which means mills will be more aggressive on export pricing. So this is a number which has to be watched monthly, as this is the best leading indicator of Chinese export pressures on India. And the next part, these are certain indicators that cover the Chinese steel demand, for instance. On page 16, the three important demand charts include China's manufacturing PMI, which has fallen back below the 50 mark in Feb 26, signaling contraction for the second time in 3 months. China's real estate sector, which is shown in the chart below, typically accounts for 30% of steel demand in China and remains in an sustained downtrend. New construction starts are at multi-year lows, and the property sales, while showing a slight uptick in December, remain structurally depressed. On the next page, we see the automobile registrations, a major steel and use sector for China. The January 2026 registrations have fallen by around 28.3% month on month. So why has this happened? This is because Chinese buyers are rushing to buy more cars in late 2025. This was before the government nearly reduced its EV purchase tax exemption by 50% on the 1st of January 2026. So it was quite evident that the demand, which saw a rise in December, was going to see a natural payback in January. Putting all of this together, China's domestic demand for steel continues to remain weak across the construction, manufacturing, and auto space. This is why its mills are exporting aggressively, and that is precisely why India's safeguard duty is not just helpful but necessary for protecting the domestic industry from further cheap imports. The next page is rather just a quick glance of how the other countries are doing in terms of production. So we have Japan, USA, and Russia. You can see the production trends for these countries in this page. One significant thing to look at here is that USA has now surpassed Japan to become the third largest steel producer. This is because Japan's production or demand for steel is more or less export driven. And given the softer steel cycle that is seen globally, Japan's production has been on a declining trend, which has led to USA surpassing it to become the third largest producer. So we have now covered the ferrous part of the report. Now we can move ahead towards the non-ferrous part. When you look at the aluminum price chart, this is the most visually dramatic chart in the report. So look at the spike to the far right of the chart. On 6th March 2026, you can see that aluminum hit an all-time high of $3,493 per ton. For context, in only 2024, the price was around $2,200 per ton. So we are looking at a 59% rally from trough to the all-time high. So the basic question that comes after this is what is driving this rally? So as we discussed in the synopsis, the Catalan shutdown and the Strait of Hormuz fears are the immediate catalyst. But the structural story is equally important. LME aluminum inventories have been falling consistently for over a year, as you can see in the chart below. The inventories have gone from 1.12 million tons in May 2024 down to 0.47 million tons in February 2026. This represents a 58% decline in inventory. When inventories fall this steeply, it is quite natural that prices become very sensitive to any supply disruptions, and the disruptions that have been seen in West Asia are quite the tailwinds for the prices to increase further. The chart below that covers the alumina price chart, which is the raw material used to create aluminum. So you can see that the upstream cost has cooled from the early spike near $900 per ton and are now at around $300 per ton. So this is actually positive for smelters because as I said, the lower alumina cost means that the better margins are there even at the current energy prices for integrated smelters. For Hindalco, which is an integrated producer right from bauxite to alumina to aluminum, this is a double benefit as the lower input cost and higher output prices really help support their earnings. And one correlation which can be seen in the aluminum prices and the stock return prices, we have Nanco. The stock is up around 107% in over 12 months and over 85% in 6 months. And it is exactly reflecting the aluminum price surge. So as I said, the commodity prices are having a direct or much more direct correlation with the stock prices in the Indian markets as well. The next page covers the copper prices. The copper price chart shows the extraordinary rally from around $8,900 per ton in January 2025. The prices have touched an all-time high of 14,000 tons, $14,000 per tons on the 29th of January 2026. However, the prices have now pulled back to around 12,800 levels currently. The January spike was driven by speculative buying in China, plus the excitement around the structural demand story that came out from the AI data centers, EV charging infrastructure, and power grid upgrades. When you look at the chart right below it, the inventory chart explains the pullback. LME copper inventories have now jumped 45% month on month in Feb to around 254,000 tons, which is a 7-month high. This inventory buildup has capped further upside in the near term for the LME copper prices. But do note that the inventories were as low as 91,000 tons in June 2025, and they have risen from those extreme low levels and are not yet around the levels that would suggest a bearish reversal. So the structural deficit for now remains intact. For Indian investors, Hindustan Zinc has copper exposure, as does Vedanta. But perhaps more importantly, the copper story is a global leading indicator, which means that whenever copper demand is strong, it typically signals that healthy industrial activity is being witnessed globally, which is a positive for the metal sector overall. Now, moving to the next page and looking at the zinc prices. The zinc prices are currently at around 3,299 per ton as of February, which is significantly higher than the mark of 2,557 seen in April 2025. The inventory chart shows a dramatic story. Inventories have fallen from 181,000 tons in January 2025 all the way to just 35,000 tons in October 2025, which is a nearly 81% decline before recovering to 97,000 tons in February 2026. That mid 2025 inventory squeeze is what drove the price rally. Now that inventories are rebuilding somewhat, the near term outlook is range bound. Hindustan Zinc is the primary Indian play, and the stock is now reflecting a 38% 12-month return, wherein true correlating with the zinc price rally that we had seen in mid 2025. Next, we have lead. Lead is the weakest performer in our metals coverage. Prices are at 1,917 per ton in February, roughly flat over the past year. The inventory chart shows a sharp 39.2% month-on-month rise in February to around 286,100 tons. These rising inventories plus the muted demand from China equals the price pressure that has been seen in the commodity for the last year or so. Quick overview over the prices of nickel. Nickel is now, I feel, the most interesting non-ferrous story after aluminium. Prices have moved from around 14,600 per ton in May 2025 to around $17,641 per ton in February 2026. So there are two forces at work here. First is that Indonesia's lower production quotas, as we saw in the sector newsletter. The approved quotas are at around 260 to 270 wet metric tons against the required 340 to 350 million tons for full capacity utilization. So this is a structural supply tightening seen in the nickel space. Second, the Gulf conflict has disrupted sulfur shipments from the Middle East to Indonesia. So sulfur is used to make sulfuric acid, which is a key input in the HPAL nickel processing route. Indonesia imports around 75% of its sulfur from the Middle East. So disrupted sulfur supply means that the nickel production in Indonesia is adding to the supply tightness. However, the inventory chart shows LME nickel inventories are actually rising. Now at 288,000 tons in February, up from 172 a year ago. Ample above ground inventories are limiting the upside. So the nickel prices are firm, but a dramatic rally is unlikely until the above ground stocks start declining. So we need to watch this chart keenly for the coming months, as the implications of the lower ore quotas might start finally result in the inventory starting to decline firmly and the prices starting an uptrend. On the next part, we look at so we are done with the non-ferrous part as well. A bit extension of the ferrous segment, we now look at the ferrochrome sector. So ferrochrome is a niche but important segment. So ferrochrome is basically used to make stainless steel, and around a ton of stainless steel requires 10.5% of chromium to be really called stainless. So chromium content in stainless steel is provided through ferrochrome, and its prices are largely determined by the interplay between South African and Indian production cost and the global stainless steel demand. So as you look at the chart, the India's chrome ore production in January 2026, the chrome ore is the raw material required for producing ferrochrome. So the raw material production in Jan 26 was 0.34 million tons, up 53.9% year on year. However, it was down 26.1% month on month. This month on month drop reflects the seasonal factors and mine level scheduling rather than a structural decline. Below it, we see the main price trend, which is the high charge ferrochrome price. So the prices have jumped from 12.5% in February to rupees 1,23,000 around per ton, which is a sharp monthly move. However, the development is to track that South Africa has cut power tariffs for its ferrochrome industry, as we saw in the newsletter, which means that South African producers remain competitive for now. This is a development which needs to be tracked regularly, and its impact shall only be seen or understood as and when the South African smelters revive their operations. Overall, for now, the tight supply is pushing the prices higher or are keeping the prices firm. Below this particular chart, we see the price chart of stainless steel 300 grade. So 300 series is the most commonly used grade of stainless steel, which is around 55% of the share of global stainless steel demand. It is used in everything right from kitchen appliances to hospital equipment. So the prices have it has increased marginally to rupees 1,94,000 per ton in February. This is because the nickel and ferrochrome prices, which are the key raw materials for producing stainless steel, are both firming. And it is just an understanding that the stainless steel producers are more likely passing through these faults. Now moving on to manganese ore, this page covers more or less everything about MOIL, which is the India's dominant manganese ore producer and a government-owned company. Manganese ore is used in steel production to improve the hardness and strength. The price chart shows a consistent uptrend, right from rupees 15,700 per ton in January 25 to rupees 20,700 in February 26, which saw a further 2% hike in March 2026. So that is a 32% price increase in 14 months. On fundamentals, this is an excellent picture for MOIL. The production chart shows that MOIL's best over 3Q production of 0.48 million tons in 3Q FY26 meant that the production was 3.7% YOY increase. A record quarter, but the sales chart tells a less happy story. 3Q FY26 sales were 0.37 million tons, down 3.6% year on year. Production is rising, but sales are lagging, and this implies inventory is building up at a MOIL's end, potentially because steel mill offtake has been below expectations for quite a while now. Now, this explains the disconnect between MOIL's strong fundamental picture and its weak stock performance. The stock was down 12.8% for over a month and provided negative returns over the past 12 months until yesterday, wherein the management has now come out with its guidance for the fourth quarter, and it states that the production is to be on a record level once again, and this resulted in the price reacting to this guidance and hitting a upper circuit yesterday. So that was about for the ferrous, non-ferrous, ferrochrome and manganese ore updates, which we cover in the report. Now the next part is for the peer comparison table, which is there on the next page. It covers the domestic and global peers. So for this, I would request Harsh to continue.
Yeah, so if you look at the peers, so as you see, the top companies, if you talk about the Indian listed companies, you have JSW Steel, Tata Steel, Jindal Steel, and SAIL. And as per the Bloomberg estimates, we expect JSW Steel, Tata Steel, and Jindal Steel to report a PAT CAGR of more than 100% over the FY25 to FY27 period. Then talking about the global peers, you have ArcelorMittal and you have Baoshan Iron and Steel Company and Nippon Steel Corp. So if you see, they report their numbers in CY terms. So you have the price chart, like you have the estimates from CY24 to CY26 estimates, where you see approximately 30% growth in CY24 to CY26 PAT. Then, over here we've listed all the ferrous companies as well. Like you can see the Hindalco, Nalco, as compared to Aluminium Corp of China, Norsk Hydro ASA, and Alcoa. And then followed by mining companies, there we have Vedanta, Coal India, Hindustan Zinc, NMDC, Moil. And the mining global peers, you have BHP Group, Rio Tinto Group, Glencore, and so on. And over here, we've just, inculcate one glossary where you can understand the basic terminologies relating to the metals report. So over here, we have just described if if you come across any terms, so over here, you can just go through the glossary, which is, which describes about that particular terminology. Yeah, so that was all from our side. And, we are open for Q&A. So we'll wait for 2 to 5 minutes and let the questions assemble in the queue, and then we can take on the question and answers. Thank you. चलिए बोल फिर मैं आगे बोलता हूँ.
Yeah, so there's one question that Shelly Engineering has hit dual circuit. Can we give view? So it has not hit a dual circuit. It hit the upper circuit of 20% yesterday. So the company is what we like to call the proxy to the GLP-1 story. So GLP-1, that is semaglutide, is a drug which is used to see weight loss effects in patients. So Shelly basically makes the injectors, which are the pen injectors for the semaglutide injections. So the story is that the patents for this GLP-1 drug is now expiring, particularly in January in Canada, and now in March for the emerging markets of Brazil, India, Middle East. So this is the story for Shelly Engineering. This is the story for the company has partnered with some of the major first filers in India as well as globally. And yesterday there was a news that Zydus Life Science has entered into a partnership with Lupin to market semaglutide in India. So that is nearly one of the reasons why the stock saw a potential rally. And for us, we feel the company is a really good bet when we look at the momentum which is seen in the GLP-1 related stocks. So yeah, we are quite positive on the stock, and one can look to accumulate the stock.
Yeah, then we have the next question from Prashant Bhaviskar that please elaborate more on about NMDC. So if talking about NMDC, so if you look at the global benchmark prices of iron ore, so that are hovering around $110 per ton. And this has, like if you see the data of the past 6 months, the international prices have hit a high of 6 months in the near term. And but however, the Indian NMDC prices are still, they have taken a price cut 3 months back and are still hovering at near 4,700 to 4,800 levels. However, if you look at NMDC's productions and sales, they have been reporting robust numbers since November and November, like December, Jan, Feb onwards. And like one can accumulate NMDC at these levels. And we think that the future target price could, be up to 90 to 95 rupees. So one can, accumulate NMDCs at this level. Then we have the next question from Amit Chatterjee that is there any scope to accumulate Tata Steel for long-term investment? Yeah, so Tata Steel, if you, recently a month back, a month or so, we had, come out with our third quarter FY26 Rockstar report where we have also provided a buy call on Tata Steel at a CMP of rupees 191 with a target price of 220. Looking at the robust HRC prices, which have increased by approximately 20 to 25% in the past 2 to 3 months post the implementation of safeguard duty. So this will augur well for the company. But one also has to look at the input raw material prices, such as coking coal prices, which are hovering at around $240 per ton, which has also increased from around 190 to $200 per ton to $240 per ton. So these both are going hand in hand. But if you look at the if we look at the fourth quarter results, we feel that the numbers would be better sequentially, as the company has itself told that the revenues are going to increase by approximately $2,500 per ton or 2,500 rupees per ton. So overall, in and all, if you see the Tata Steel capacity as also increased, the Vijayanagar steel plant has come online by approximately 5 million tons, and the company has also given a hike of long-term guidance and currently FY26 guidance of more than 1 million ton additional sales and production as compared to the last year. So one can also invest in Tata Steel with a target price of rupees 220 to 230.
So the next question is that due to the war in yeah. So the next question is that due to the war in the Middle East, the Bahrain aluminum smelter is closed for an indefinite period. So is it good for Indian aluminum companies, especially for Hindalco and Alco for international demand? So the Bahrain aluminum smelter is closed due to the supply chain disruptions with regards to alumina. So the raw material which is required for producing aluminum is alumina, and the smelter was not getting ample amount of raw material to continue producing aluminum. So that is the major reason for the shutdown of the smelter. Now, with regards to Hindalco, Hindalco is obviously an integrated player, so that is quite the headroom for us for the Indian company to keep on producing aluminum. So obviously, given that the shutdown has been seen internationally, not just at Bahrain, we have seen Catalum also shut down its aluminum smelters. So that means the production is now getting tightened, and there has been quite a handful of demand for aluminum recently as well. So the structural deficiency is continuing to increase, and which means that the prices are also going to increase internationally. The only thing to track would be that the war has resulted in the supply of LNG gases getting restricted, which is also used for the production of at these smelters. So the one thing to track would be in the coming days whether the company comes out with a circular that the production operations have been halted at its smelters or not. That is one thing which needs to be tracked. But on a broader perspective, obviously the aluminum prices are going to be supported due to these shutdowns, which are seen due to the West Asia war. So yeah, that was about Hindalco and Alco.
So just adding to it, you can accumulate Hindalco and Nalco, and the fair value of Hindalco would be around 1,050 to 1,100. But one also needs to look at the B Minute project coming into play in the second half of CY 26, and currently the Oswego plant had caught fire. However, the company is going to receive approximately 75% from the insurance company, so one needs to track that as well. And talking about Nalco, we do estimate the fair value at approximately 420 to 440 rupees. On the back of robust LME prices, and also if you see the power requirement of the Nalco. So the coal, like if you see, it's approximately 7 million tons. But in FY 24 and FY 25, the company had approximately captive consumption of 2 million tons, which has now increased to 4 million tons, due to which the company has seen a good spike in its EBITDA margins, which is hovering at around more than 35% plus. So one can also look at Nalco as well. The next question is from Amit Chatterjee, that what is the future of NMDC Steel? So if you look at NMDC Steel, the company has still not even break even. However, the company has started reporting operating profit, positive operating profit in the past 3 quarters. But however, as if you compare the company, if you compare NMDC with the listed majors such as Tata Steel, JSW Steel, Jindal Steel, it is relatively, the giants are, listed better as compared to NMDC Steel. So, one can look into Tata Steel instead of, investing in NMDC Steel for time being.
So the next question is regarding HDFC Bank fresh buying level. So yeah, I feel we feel that the company is fundamentally good, obviously, and we can consider adding it at the current levels, because we believe that the loan growth is expected to accelerate from here on. And as per the latest RBI data, 15.2% has been the credit growth, and which is a positive for the company, and margins are also expected to remain stable. So yeah, you can consider adding the stock in your portfolio at the current levels.
Participants, if you have any other questions, you can type it in the chat box. We'll answer it. We'll wait for 2 minutes. Yeah, so as we can see, there are no further questions from the participants. We have one question from Paul. So Paul says, asking whether APL Apollo to sell or hold. So we have SB Securities that have a hard coverage on APL Apollo, which is under our product name Rising Stars. So we generally come out with the every quarterly results. So you can refer to our third quarter FY 26 results, where we have given a buy call, and with a target price of approximately 2400, more than 2400 plus. So if at this current levels, you can buy APL Apollo, as we expect the company to report robust volumes. But however, due to the ongoing war, there has been a slight dip in volumes due to the company having a plant in Dubai, where it also produces galvanizing tubes, and which requires gas and LPG. Over there, due to that limited constraint, the production's volume may drop. However, we'll wait for further update from the company. Once its fourth quarter volumes are done, it will report, and then we'll signify whether with our new quarterly result, whether we should what's our status on that. But for time being, you can currently hold if you have. For fresh buying, you can also take into consideration. Yeah, so as we don't have any further questions, we can end this session. So thank you so much, all the viewers, for taking out time. Thank you.